Welcome. Welcome, everyone. It's Angelo Robles. For my members, welcome SFO Continuity. And for those joining us across my socials, welcome to @Family Office. I know I haven't done as much interviews. It's been a lot of solos and a lot of travel around Florida, LA, and a brief jaunt, important business to Europe. But I'm back in the saddle again. It's great, I think, to be back. And I have an amazing guest that we haven't had on in multiple years. So the title of our conversation today, it's a real pretty sexy one. From CIA to crypto, billion-dollar bets and the future of money. It features Bill Barhydt. Bill is a serial entrepreneur, a pioneer in the world of internet technologies and crypto for multiple decades. Many of you would know, come on, he's the founder and CEO of Abra, the world's leading crypto investment platform. He started his career, like my title hinted, at the CIA on effectively secure messaging systems and at NASA actually as well, and also at Netscape. I don't know, these little government entities and amazing companies. So Bill, it's been too long. Welcome back.
Thanks for having me. It's really great to be here.
My pleasure. And back in the day, for me, that would probably be during COVID, 2020, even into early 2022, I was very, very active in crypto. And many of you have noted, come on, Angelo, you used to have Michael Saylor on and all these big figures and Bill and other big figures in the world of crypto. I mean, AI kind of got my attention. We may put a little bit of focus on that with Bill, but you called for it. Here you are. We have Bill Barhydt on, so we're going to make it happen. We have a lot to cover in, by Angelo standards, only an hour, not my normal 2.5 hours. So on that note, Bill, I'm just going to get right to it. We're going to cover a lot of different things. Why don't I start with Bitcoin? So it's at what, about $80,000. I remember you calling for a $350,000 base, maybe a $700K high, kind of cyclical Valhalla was the phrase. Are we still going there, Bill, or did the gods effectively change the plan?
Yeah, look, I think the market is telling us what we need to know, and a few things, right? So we were at, I think, 40,000 Bitcoin or 45,000 Bitcoin before the current administration came in. I think there was a regulatory overhang as it relates to price on the industry, and that regulatory overhang was lifted. We got to 125,000 fairly quickly. I think mostly as a result of that, the euphoria around that regulatory overhang being lifted. I think that in the meantime, two things happened. The AI trade came in and the government liquidity slowed down temporarily as a result of, going from effectively negative real rates to, 5% and having very sustained high rates, which we hadn't had for decades, right? So on a relative basis, meaning we hadn't seen that level of convexity in interest rates in decades. And so the overhang of that is probably the reason for the slowdown outside of the AI sector, right? I mean, productivity is basically spinning its wheels right now in this country, mostly because, the slowdowns are being offset by data center build outs and the adoption of AI. And I think what's going to happen this year is you're going to see massive liquidity injections by this administration, meaning it's going to spend any way it can. Which is what you typically see in a cycle like this, especially when we have the midterms coming up. And I think that level of spend is basically what we were expecting last year, to be honest, and we didn't get for the reasons I just described. And as it comes, I think you're going to see a methodical march towards Valhalla over the next few years, and then typical pullback. But I do think you're going to see something in that 250 to 500K range over the next 5 years minimum. I would be very surprised if it was anything less than that as the highs and potentially higher.
You survived. You're like an OG in Bitcoin. What, probably 70% plus drawdowns, and your line, if I remember correctly, when in doubt, kind of, well, of course, zoom out. At what point does zooming out become I could state a bit of a coping mechanism instead of a strategy?
Well, if your time horizon is forever, your ability to see reality by zooming out should also never fade, right? As Warren Buffett says, the longest, the ideal time frame to own an asset that you have conviction for is forever. And I agree with that. I think that most people diversify because they have a lack of understanding and conviction for what they're investing in. So rather than figure out how to get conviction, they simply diversify. And that's not, what most billionaire investors do. They have concentrated bets based upon conviction, but their time horizon is generally a very long time, or they're willing to let it be a very long time, right? So to me, that means that if you're not willing to, zoom out and see the big picture and have conviction for what you're doing, you need to adjust your sizing and your time horizon and risk profile accordingly. But for me, when it comes to Bitcoin, the reason I have perpetual conviction is that you have a guaranteed scarce asset being priced in an asset that we're inflating to infinity. So if you're going to continue to price the scarce asset in an asset you're inflating to infinity, and you have any type of conviction around adoption, the numbers should be very clear as we march forward towards that eventually even $1 million Bitcoin price. And there's a lot of other things going on in crypto besides just the price of Bitcoin. But as it relates to Bitcoin, it ultimately is an equation on scarcity, right? Bitcoin is guaranteed scarce. The dollar is pretty much guaranteed to be inflated to infinity. When you marry those two, something has to give.
I think you were hinting at this earlier. We'll jump right into it. The US government is sitting on about 328,000 Bitcoin in strategic reserve, more than any sovereign, if I remember correctly, on earth. The Bitcoin Act could authorize the Treasury to buy 200,000 Bitcoin BTC per year for 5 years. Here's the comedic part, when the entity that printed the dollar starts hoarding the asset designed to replace it, what is actually happening?
When you're inflating the dollar's value to zero, right, which the government has to do, it has to debase its currency when it's sitting on $1 trillion debt servicing payment and is taking in proportionally less money every year, and nobody wants to pay more taxes. The cost of living is going up. Right, the government has to debase the currency or absorb the fiscal pain of what it would take to reset, which would take probably a couple of decades at this point.
Which means no politician would get elected on that platform, although it's logical.
100%. But you need term limits to just, and that's not going to happen in my lifetime. Maybe it'll happen in my kid's lifetime. So I think this debasement trade is the future. And I think people who aren't preparing themselves to understand, your constituents are highly incentivized to understand this. Put aside your personal feelings on government and, I'm a libertarian, and I put all that aside and I say, okay, I understand why everything works the way it does, fine, better or worse. What am I supposed to do to protect myself in an environment where the debasement trade has to be the norm? Because we're not willing to absorb the pain to get our structural house in order, right? Well, scarcity wins in that scenario, right? You have to own assets that are scarce. If you're investing in things that enable infinite abundance, you're basically investing most likely in something going to zero, right? And so right now we have infinite demand for compute, for example, but very limited supply relative to demand, right? That's why the price of assets that are key to making that supply meet the demand have been skyrocketing for 3 years, right? And I think crypto, as another example, is going to be a key enablement technology for the future of the agentic planet, the agentic internet, whatever you want to call it, as the transaction layer. And I think you're going to see demand for certain kind of layer one blockchain technologies also skyrocket, commensurate with what's been happening with the compute-oriented technologies as well.
Yeah, that's a great analogy. Staying a little bit on that theme of the question that I asked, if the US starts, which they have, actively buying Bitcoin, doesn't that fundamentally kind of break the decentralized thesis? A sovereign with unlimited fiat buying power can manipulate any fixed supply asset. How is that different than what central banks are doing with gold?
Yeah, I would posit that at scale, that thesis breaks down, because Bitcoin itself, right, is decentralized in not only in terms of who can own it, right, but how it manages consensus and how the incentives work. That entire framework itself is decentralized. And so it becomes a circular discussion, because the more people that are buying it, the higher the price goes. The sheep want it. More people want it, the higher the price goes. So Michael Saylor can't just basically assume that if he just basically raises $100,000 per Bitcoin, that he can do the math linearly and own 5% of all Bitcoin. The cost of getting there is actually going to go up logarithmically. It's going to go up exponentially over time, because everybody is going to want in as the price continues to go up and the network effects kick in. Every node you add to a network causes the value of the network to grow exponentially, not linearly. That's why Facebook's value, if you remember when it was growing, when it was a private company, it seemed like the next round added another zero to the private money price, because the value of the network was growing exponentially. Bitcoin is a monetary network. And the more people we add to that network who are holding Bitcoin, the faster its value grows exponentially. And so even the government has to pay the market price for something, which in this case could be growing exponentially. So it feeds on itself. In other words, if the government puts $200 billion into Bitcoin, it's going to cause the price to probably 10x. Okay. So it's only going to be holding 1/10 of the Bitcoin it would hold if it was able to buy it at today's price 5 years ago. You follow? And so you're not having as much of an impact on the centralization of the network as you would believe.
You said, I believe, that the Fed is running kind of quantitative easing light and liquidity is coming. Bitcoin is down. We have to admit that 35% from its all-time high. And the liquidity,
it's also up 35% since the trough.
True. But the liquidity debatably hasn't shown up. How long can that thesis survive on a promise?
Yeah, that's a great question. And so you when you think in exponential terms, it's very difficult to measure short-term results, extremely difficult. And so I'm not good at it. I don't know many people who are. I do know a few people who are, but not many. They're very, very good at making micro trades in a macro environment. I'm not one of them. I have my conviction for where the world is going, and I make 5 to 10 year bets as a result. And so if you need to make micro bets, either because of your lifestyle, because you can't stomach the volatility in the short term, which in the long term is probably not that meaningful, then you need to rethink your hypothesis around how to invest in the first place, and to deal with the emotional aspect of that. Now, that having been said, again, I keep repeating myself, but as it relates just to Bitcoin, we're not talking about any other digital assets or tokenization. You have a guaranteed scarce asset. So only two things could change to change my conviction at this point. The underlying code of Bitcoin gets changed somehow so that it's no longer a guaranteed scarce asset, or the government's position on basically printing money to infinity changes, and all of a sudden the dollar starts moving towards becoming a fixed float scarce asset measured in some commodity basket again, right? Which is where we were in the 1950s. I don't think either of those two things can happen. So since that's my conviction, the short-term gyrations, and when you're dealing with this level of adoption, these are short-term gyrations, to be clear, right? They don't matter. Now, if you can't accept what I'm saying, you need to completely rethink your investment hypothesis, because your emotions will continue to get the best of you. But I've stared at this problem long enough to have this conviction. And like I said, I am willing to change my mind under the circumstances I described, but I don't see those circumstances coming to fruition.
Well, I mean, let's talk kind of a little bit about those circumstances. So could I state the entire macro model that you may be describing is this administration wants lower rates and they'll do whatever it takes. What happens to your $350,000 call, but suppose the rates stay at 5% or more for 2 years. I guess that's not going to happen, but suppose.
Sure, but the flywheel is the flywheel. We still have to service the debt. So we have to print even more money to service even more debt because the debt is more expensive. Something is also structurally breaking. So just because the government desperately wants rates lower and the Fed may blindly lower rates, which I don't think Kevin Warsh is going to do as the new Fed chairman, they have a structural problem because they've tried to lower rates 3 times in this cycle. And each time they've tried to lower rates, there's been a spike in bond markets. That's not supposed to happen. Why is that happening? Well, it's happening because the demand curve and the way that we've traditionally thought about demand for treasuries is changing. Meaning, hey, you're basically breaking the grand bargain that you made in Bretton Woods, which is that you would police the world, the dollar would become a stable currency, and we would therefore happily execute transactions along U.S. police trade routes at dollars. Well, nobody believes in that bargain anymore. Even Americans don't believe in it. But we're obviously stuck with the dollar. That's why you're starting to see China dump its, well, not starting to, they've basically dumped their treasuries to a large degree in exchange for gold, right? Other oil exporting countries are now willing to accept non-US currencies. And Trump is basically playing a global game of risk where he basically says, well, wait a minute, I need to control some of this distribution channel because if I can't perpetuate the value of the dollar, our entire system breaks down and the U.S. empire crumbles. And this is the point that Dalio makes, is that we are in a late stage debt cycle in a declining empire. I don't want that to be true. It just is, right? So this is the game that we're playing. And so the question is, can in that model, to your question, the U.S. actually get long-term rates down? Yes, but at what cost, right? Everything comes at a cost if you're basically printing money. So you have to pick your poison, right? So you're going to buy bonds yourself. Well, guess what you're going to have as a result? You're going to have 5 to 6% sustained inflation as the norm. 2% is done, right? In a $1 trillion debt service model, 2% inflation is not happening anymore, right? So what's the norm? Is it 3, 4, 5, 6, 7%? I don't know, but it's certainly not 2. And so if you want the long-term rates to come down to service your debt, you're going to have to buy the bonds yourself. And it's the middle class that's going to have to pay.
You floated, if I remember correctly, kind of a capulation move of 50 to 55,000 as kind of a shallow bear market. For a family office sitting on $200 million in dry powder, would that for them be an entry point, or do you tell them to wait for the bleed?
No, I look, if that was me, I'd be backing up the truck, but I'd also be looking at this as a 10 to 50 year trade minimum, right? And 10-year minimum, 50 years if it's a family office looking at allocations in perpetuity, at least for now, because we're talking about intergenerational wealth protection in what is a late stage debt market in a systemic reset. We are in the middle of a systemic reset right now, meaning that there is a new financial world order emerging. It will be 24/7. It will be tokenized. It will be global. It will be borderless.
And we are things like that audience, I promise.
Yes, and the Clarity Act and Genius Act will help make the U.S. part of it, but you can't stave off what's coming at this point. But what you can do is protect yourself. All of this, by the way, wrapped in a layer of AI, which barely anyone is getting their arms around yet. And so the world order that's changing is truly dramatic in scope, and the likes of which we've never seen before, because we have this interconnected world with this internet layer on top, where it just used to be shipping and trade routes with steam engines and horses. And so I mean, if you're not thinking about the fact that we are in this changing world order, and you need to understand the implications of AI, of crypto / tokenization, and falling borders when it comes to digital trade, then you're sleeping at the wheel.
I would broadly agree. I'm going to make a little bit of a comment, and I'll convert it, at least to some degree, into a question. I do believe, especially for those that are over age 40, a level of arrogance and ego get in the way. They rather be right than actually make money. And they're always going to be bearish on something like Bitcoin, let alone broadly in the world of crypto. When I do talk to family offices about let's go with the word of fear, and I agree with kind of what Raoul Paul said, even if you're somewhat doubtful, consider putting 1 or 2% that you're reallocating elsewhere. It's going to be relatively, God forbid it goes to zero, for me at least, God forbid, it's not going to have any impact on you. But so that's at least a good starting point for you forming a thesis, being more educated and moving forward. But there is a question that keeps on coming back to me from people, including at my big forum in Palm Beach 2 months ago. And that is like, Angelo, I'm hearing about this quantum's getting closer, and is that going to be a threat to Bitcoin? What's your response?
Yeah, I spent a lot of time on this topic. It's a very long, involved topic. Let me cut to the chase. And I've written about this online. People can search my Bill Barr X Twitter feed and see the detailed response. But the bottom line is that Bitcoin is software, right? At the end of the day, all software can be upgraded, whether it's Bitcoin or your Oracle database. Now, the process for upgrading Bitcoin software is different because a CIO or VP of IT at a bank can simply say, here's the date, we're upgrading our Oracle instance, and suck it up. That's it. You can't do that with Bitcoin because it's a decentralized network with no benevolent dictator, no CEO, right? I am not the CEO of Bitcoin, I'm the CEO of Abra. And so as a result, upgrading the network is actually a painful experience because you have to basically get different constituents with their own financial incentives to agree. And so that takes time. Then the good news is Bitcoin has gone through this arduous process several times already to its benefit, right? That's why we have, the SegWit 2x upgrade with the slightly larger blocks and the Taproot upgrade, which enables other types of transactions. And it's undergoing a debate and process for being upgraded for quantum readiness. That's part one. Okay, so regardless of what I'm going to say in part two, it is going to be upgraded anyway. Now, and the reason I'm saying that is I think that the fear is overblown, but it doesn't matter, and it shouldn't matter. It should undergo the upgrade in a very conservative, reasonable way, and we should just get on with it. That's what's actually happening now, and that's going to take probably 4 years, 5 years. And again, you're trying to change the atomic structure of gold. That's what it's like to upgrade Bitcoin, even though it's software, right? And so it should be very hard to change the atomic structure of gold. And so that's what's happening. Now, the reality of quantum is that to get more stable qubits to execute in parallel gets exponentially harder as you grow the machine. And again, human beings are not wired to understand exponentially anything. We're just not, right? Like Einstein's famous quote about the mysteries of compound interest being one of the great mysteries of the universe, right? So again, it's just, we're all guilty of this. But because we're making so much fast progress in quantum computing, it gives people this impression that it's just a linear march towards 1 million qubits when it's not. It's an exponentially harder march the closer, the further out you get on the curve. It's fine. But anyway, I don't want to belabor this point too much longer. It suffices to say, I am convinced that this is a non-issue for Bitcoin, as much as it's an issue for our nuclear launch codes, for your Bank of America account, and for Bitcoin. It's all the same. It's all hardenable. It's all going to be upgraded, and it's equivalent to Y2K, which for the kids in your audience, that was an IT upgrade where we all thought the world was going to blow up on New Year's Eve in 1999 when computers had to reset the dates to the year 2000, and people literally thought the world was going to end. Some people, it didn't. And we ended up spending, today's equivalent of $1 trillion making sure that didn't happen, but it was never going to happen, right? And so the fear mongering here is probably worse.
So Trump pardoned Ross Ulbricht the BitMEX founders and most famously CZ within about a 10-month window. As someone like yourself who discovered Bitcoin so early, I believe 2011, and you gave the first TED talk about it, is this crypto the newest industry to learn the access to the White House? I got to ask you a juicy one. Has a price?
I guess. I mean, I don't, for me, decentralization is orthogonal to politics, right? The fact that, the president's kids may own a Bitcoin mining company, or, I may have helped, draft text in the Clarity Act. Ultimately, in 5 years, decentralization movement is going to do its thing independent of all of this. These centralized actors are kind of gateways from the old world to the new world, right? Exchanges are a facilitator of moving between the old world and the new world. And the new world is decentralization. The next phase is online vaults for storing assets and generating yield where you hold the keys, right? You don't need an exchange in that model anymore. It becomes decentralized. So everything we're talking about implied in your question, whether it's access to the government, running an exchange, being deemed a bad actor because certain people you didn't want to have access to your exchange were accessing your exchange, which was ultimately CZ's problem. They're stopgaps, or they're not stopgaps. They're endpoints on the way to the ultimate game, which is getting towards the new financial world order, which is going to be based on a decentralized internet. And the financial system itself will become decentralized and be hardened in a way that the traditional banking system never could, which is why we were always bailing out banks every 40, 50 years.
And we're going to get a little more hardcore in 1 second after one more to the Genius Act. But in building upon my last question and being sometimes prickly, that I guess I've been accused of being, and shockingly, for those of you who think I only go on the libertarian and the right side and I never challenge things, well, you'll be surprised. I occasionally do. So the crypto industry, building upon what I said, did spend $100 million plus on the 2024 election. The pardons followed. The Genius Act, which I think is genius and incredible, followed. The executive orders followed. A skeptic would say, is this regulatory capture? What would you call it?
Well, at its core, I would call it fighting back. I mean, it was we were basically undergoing as an industry an existential fight to the death, and to a degree we still are, but it's been muted by this administration's understanding, and also to a degree commiserating, because Trump had bank accounts closed when he was undergoing his government attacks, just like every crypto company in their early days, because of prior administrations, had multiple bank accounts closed. And anybody who's in any kind of fringe business of what we call cannabis or any of these things, they've all had, even money transmitters who are licensed in many states have had bank accounts closed. And so that became, I think, existential, to the point where many of the companies and my peers were like, hey, I'm just going to close shop and we're going to move to Singapore and Dubai and Zurich, because we can run our businesses legally and have a clear framework for operating within the law and add value to people and just do it from there. And the Warrens of the world, Elizabeth Warrens of the world, were winning. And, that was said, when your stated goal is to socialize the banking system, and, you're basically representing what amounts to the opposite of that, which is a decentralized system that has no off switch, which I think is the ultimate check on government power, ironically. Right now, I don't know the degree to which the president himself understands that point, but to me, it's the key point. Let me make a side point and come back to this point about the money. If you're opening an account at Abra, we're an SEC registered investment advisor. You're basically interacting with a government registered fiduciary. Okay, it's not lost on me the irony of putting myself in the middle of that when I'm trying to make decentralization technology available to my clients. Okay. But the point is, any one of my clients can take all their Bitcoin, all their stable coins, all their Ethereum, unstake it, and move it into a hardware wallet anytime they want and bury it in the backyard. Okay. And it's 100% theirs. They maintain agency. It's unconfiscatable, and they can get on with their life. Okay. That is the nature of decentralization technology. Okay. And that's the way it should work. You can't inflate Bitcoin to 42 million. It stops at 21 million, right? You can't just hack, elliptical curve technology, which is underpinning the digital signatures and these private keys that people use. And it just works. Now, all of us as companies in the space, our job is to facilitate some form of access to this decentralization technology. And as a result, we put ourselves in the middle. And as a result, financial regulation applies. And that's reasonable. I have no problem with that. Okay. Now, I may have a problem with individual laws, individual states or the federal government, but the laws are there for when somebody wants to act as an intermediary, to have rules of the road to follow to protect the person that the intermediary is trying to help. The last administration said, we don't want intermediaries in the crypto space because if we kill the intermediaries, then it's highly likely we can kill the space. And they want to kill the space because their stated goal was to socialize the banking system, especially Senator Warren, who basically ran financial services in this country under the Biden administration. That was the grand bargain she made when she supported him in the primary, when he was running in the primary against Bernie Sanders. That's how Gary Gensler became SEC chair, and anyway, she strategically placed her people all around the administration. And so, our group was desperate. I'm not going to put a happy face on it. And we went to the Trump administration, strange bedfellows, explained to them the situation, and they could easily relate to what we were going through. And by the way, his kids are whispering in his ear, hey, this is the future. You need to understand this. And we know this firsthand because we saw it in the meetings. And he got that piece of it. Like, he's not an expert in tech, but he understood enough to know that this was the future and his kids were right. And once we knew that all we were going to get was just reasonable rules of the road. Yes, I wish they hadn't launched Trump and Melania coins, whatever. I don't really care. Right. But we knew we were going to get those clear rules of the road. That was all it took for us. And we were all in. And, and to their credit, as it relates to this issue, they've come through on every single thing they said they were going to do. Right. Rules for AI, which is directly related to our space. Rules for stablecoins, which was the Genius Act you pointed out, right? SEC guidance on what's a security and what's not a security. Their March guidance undid all of the 4 years of nonsense that everything was a security, which everything is not a security. We all knew that already. We didn't need the SEC to tell us that one way or the other. We just needed guidance on how to operate within the framework that we already know that everything is not a security, right? And now this culminating in the Clarity Act, which is coming out of the Senate Finance Committee today. And I was actually watching the hearing before the day we're taping this. I was watching it in that moment. And so it's truly done exactly what it said it's going to do.
So the Genius Act, looking back to last summer, stablecoin issuance is, I could state, kind of restricted to banks and federally approved entities. The OCC rulemaking deadline is, a couple of months out. Did Congress create a framework for innovation, maybe, or hand the banking lobby in its own way a monopoly on, let me use what could be an ugly word, programmable money?
Yeah. Look, banks don't innovate. So let's just get that out of the way. Banks aren't there to innovate, right? They're not anointed to be the purveyors of the future of technology. They're there to minimize the chances that the government will have to spend FDIC money to get you your money back. Okay, while they're lending out 6 times more money that they've taken in. Okay, so reconcile all of that. As the average person who with a brain looks at this and goes, well, this doesn't make any sense to me. But whatever, that ship has sailed, right? If you're thinking about it in terms of our space, the innovation happens at the decentralization layer. It's DeFi. It's on-chain vaults, it's on-chain lending. These are technologies that banks may adopt in the next 5 years or 10 years, but that is where the innovation is happening. And that is where a lot of what's happening with the Clarity Act, for example, is so essential, because it puts a moat around that space and lets us innovate. And that's what we've wanted all along. We don't want to be deemed criminals for writing software that basically allows you to borrow against Bitcoin on a decentralized network. It's very basic. And I'm very encouraged by what I'm seeing out of the Senate with this version of the Clarity Act in this regard. And again, a stablecoin is a centralized concept running on a decentralized network. And so the centralized issuer of that stablecoin, because they're operating within the existing financial system, probably should be regulated to the degree they are. And this country, can't afford right now, for better or worse, as somebody who believes strongly in competition, can't afford to have a mass migration out of the existing banking system, because it would collapse. If it did, everything would collapse, right? It would be like a Great Depression. So I understand why they did it the way they did in that regard.
I mean, maybe for the audience that is not as familiar, and we don't want to make it too regulatory based, we have tokenization and exciting topics to get to, and how family offices should be allocating to the space, but maybe kind of putting a bow on it. I mentioned the Genius Act from last summer. You mentioned a Clarity Act, which is happening right now. Like you said, this administration, inclusive of the president, Bassett, and everyone, is very crypto and AI focused, which is really the future. In our competition with China, and let's face it, it is, these are very, very important. And the US dollar, the world still settles in it. Stable coins, going back to the Genius Act and the Clarity, which you'll maybe summarize, leading into stable coins. And I mean this in a positive way. It may not come across that way to some people. Let a brilliant move in stable coins to keep the US dollar somewhat Ponzi alive and kicking for
100%.
Many more years to come. I'm being a little tongue in cheek, but I guess true. Your perspective on it and tying all this together.
Yeah, look, we talked about it earlier when we had the macro discussion. We talked about China dumping treasuries in favor of gold. And so now we're at a point where I believe, the largest buyer of US debt is us, meaning, our government. That's not a good look. And we went from all of the top 10 buyers being, sovereigns, to now one of the top 10 buyers being a company, namely Tether, right? So for the audience, it's not clear because they operate outside the US. Tether is the largest global issuer of stablecoins, and they issue stablecoins in the US dollar, but they do it from outside the US. And they hold treasuries in order to peg the value to the dollar and keep the interest on those treasuries themselves. So they're one of the most profitable companies per employee in human history. And they simply, work with the US bank to maintain those treasuries. So of course, this administration is highly incentivized to perpetuate that concept, because the more demand there is for treasuries, the better the chance they can keep those interest rates muted while everybody else is becoming a net seller. And so now, that is not a viable long-term strategy to stave off the death of the dollar. It's not, okay? But it can hurt in the short term. And this administration really understands that, right? And so to the degree that they can basically get stablecoin issuers all around the world to adopt the dollar, right, or dollar stablecoins, the better, right? And it turns out that, a lot of international investors would rather hold dollars, even if it's losing 7% of its value, versus their local currency, because their local currency is falling even faster, right? So if you're in Nigeria, would you rather hold the Naira losing 15% of its value a year, or the dollar losing 7% of its value a year, right? So that's the choice. And most people would rather hold the dollar in that instance, even without the yield, because Tether keeps the yield.
And well, you did mention Tether. Let me throw them into one question as well. So a lot of people don't know Tether processes more daily volume than Visa. One, let that sink in, audience. They've never been fully audited by a big four. They operate, as you noted, offshore under the Genius Act's foreign issues provisions. Can Tether survive in its current form?
Yeah, I think it can. We haven't even seen global payment volumes migrate from traditional debit networks to stablecoin networks. Forget about credit for a second. Credit is a very US centric thing, but Visa and MasterCard at the end of the day are really debit networks with an overlay for credit transactions, right, via the acquiring to the issuing bank. And that layer of complicated gobbledygook is like simplified from a 15-person supply or 15 entity supply chain in the debit world to a 2-entity supply chain in the stablecoin world, and which also means far fewer hands in the pie and instant. You get near instant finality in payments. You eliminate the opportunity for chargebacks, which for cross-border global commerce is essential, and all other benefits that you just don't have with the debit networks. The debit networks serve a fantastic purpose given the nature of how they were created in a fragmented global banking system. But in a new financial world order of decentralized systems where you don't want to be dependent upon centralized banks, the stablecoin model is brilliant because it allows you to leverage the bank to store the underlying asset, but use the decentralized network to move that asset around.
Let's switch a little bit to tokenization, because now I think family offices, with the foundation that we laid, they want to hear some of this. You said everything will be tokenized: Tesla shares, SpaceX, real estate, every portfolio managed through tokens. Kind of what's actually kind of stopping that right now? Is it technology? Is it law? Or the fact that Wall Street makes too much money on the friction?
It's all of the above. Look, let's start from first principles. How do things work today, and why does tokenization matter? Okay, so today, if you're talking about traditional markets are closed more than they're open, right? Meaning 168 hours a week, and 35 of them you can trade stocks in the United States. Okay, now separate from that, right? If you're wealthy, like family office, you can go to Goldman or your Prime and borrow against the value of your portfolio, right? Most people can't do that today, right? But the family office can. That's interesting. But the problem with that is you end up with price discovery issues because the value of the portfolio in many instances can only change 35 hours a week, right? Whereas global macro events don't have an off switch. In other words, if we're bombing Iran on Sunday afternoon and oil is skyrocketing, lenders have issues because the value of that portfolio is in flux, but they can't do mark to market on the collateral for a loan because the markets are closed, right? So now let's talk about the world of crypto. Bitcoin has become an interesting proxy for macro because 1, it's guaranteed scarce, 2, it's global, and 3, it trades 24/7. Right? So what that's shown us is if you could take traditional assets, make them tradable 24/7, tokenize them, right? You have instant global 24/7 price discovery, but you also facilitate the ability to make those assets liquid on global lending markets, particularly DeFi markets, which are exploding in popularity. Okay. And they go hand in hand with prediction markets to a degree. And so these lending markets combined with tokenization give you an unlock of liquidity, to the tune of probably tens of trillions of dollars, not only for equities, which is the easy part, but things like private credit, real estate, right? Other types of supply chain credit that are shut out to the West because supply chain credit markets are traditionally an Asian phenomenon, and so the number of opportunities coming our way, for example, about can you help me tokenize X to unlock this is skyrocketing. And so I don't have as many debates about why tokenization matters anymore as I used to. And maybe we can thank BlackRock for some of that. Because they started with money market funds, which is actually the least interesting thing to tokenize. It's not uninteresting, but it's not the most interesting, right? It's interesting insofar that if you're a small community bank and you're running a money market, you can now buy and distribute BlackRock's tokenized money market fund to your clients, pay them, a few bips, and you've got a better product for your local community bank potentially, right? Or as a second product, something like that. Or maybe you're innovating at the local level and you want to distribute at the national level. I don't know. Right. And so, money markets are interesting to tokenize. They're just not the most interesting thing. Getting access to hard to access things is way more interesting to me, right? Taking alts, making them tokenizable, making them easily, fungible, having instant price discovery for things that are illiquid. Like if you're investing in sports teams today, right, which a lot of family offices are interested in, and you can tokenize those investments to make them fungible, on the likes of a crypto exchange, and you can sell 20% of a $100 million position and have instant price discovery, or borrow against the value of your ownership in the sports team on a DeFi network. That's an unlock that is very complex today. That becomes much easier.
100%. You mentioned BlackRock. So BlackRock, Fidelity, Franklin Templeton are all moving on chain. Does TradFi arriving with that balance sheet legitimize crypto, or does it just absorb the thing that crypto was meant to disrupt?
Yes. So let me explain what I mean. So I just came back from the Consensus conference in Miami, and that used to be all about Bitcoin, Ethereum. Went through its NFT phase, its DeFi phase. This year, it was all about traditional finance, leveraging crypto technology, whether it was for tokenization or lending or custody or stable coins, which is the big 25 was all about stable coins, but there was a lot more of it this year. All of that was traditional financial players absorbing crypto technology. Even my panel that I was on, I was literally on a panel with I think the head of digital assets from BlackRock and Citi. Like if you would have told me 10 years ago when I started Abra that I'd be doing panels with BlackRock and Citi on crypto, I'd be like, first of all, there was no crypto, it's just Bitcoin. But I would have said like that's crazy. Like they don't even understand what I'm talking about. And so here we are, 10 years later. But the point is like, okay, it's a means to an end. It's all about the first principles I just talked about. It's about unlocking liquidity, 24/7 price discovery, enabling lending markets, and all those things that add value to them. They're not just trying to be good stewards of decentralization. Honestly, by and large, they couldn't give a crap about decentralization. What they care about is I'm managing trillions of dollars in assets, and I need to make sure that I don't lose those assets. I don't mean physically lose them. I mean, people basically say I should be holding them somewhere else in this new tokenized world order. And so it's existential to them in so far that they have a lot to lose. And so this becomes almost like a protection policy, an insurance policy around the future of asset management, in my opinion. And they are and Larry Fink is highly incentivized in particular to understand this. And he's kind of pulling others in the space, and to some degree, kicking and screaming towards understanding this. And kudos to him. But again, I'll never see banks and asset managers or RIAs as stewards of decentralization technology. I'll see them as stewards of people's current assets that are highly incentivized, not only to fulfill their fiduciary obligations to their clients, but to protect their businesses. And in the new world order, that's a tall ask, all right, because their value gets greatly diminished. If I can run an AI-based portfolio construction tool that rebalances a tokenized portfolio in real time and uses a qualified custodian, or I can even put my keys in a vault and still have the portfolio constructor rebalance my portfolio. What value is BlackRock or an RIA adding in that scenario? And I have an answer, and they have an answer. But if they don't act on it and get into this quickly, their value is going to go to zero.
Excellent points. Let's take a little bit of a look in the future. And I don't mean 10 years, kind of happening now, but imagine 6 months from now, a year from now, 2 years from now, and really getting into my wheelhouse of AI integration for family offices. So we'll have a little bit of fun here. AI agents that hold wallets, execute trades, move capital across chains autonomously. That's not theoretical, kind of right now, but where does AI on chain actually get interesting versus where it's just still conference panel talk because it sounds cool and exciting?
Yeah. So I think there's 3 ways AI changes our business in my world permanently, like not just short term, but permanently. The first is what we're already doing. Our business is basically yield and lending. We facilitate yield on stable coins, Bitcoin, Ethereum, and we facilitate loans against those assets for our clients. It's that simple. Family office comes to us with 50 million in Bitcoin. They want to earn yield on it. They want to borrow against it so that they can either get a little bit of leverage or make other investments without having to pay taxes. Abra's master at doing that. On the yield side, we're already using and running multiple agents to assess new yield opportunities that are very safe for clients, which will then go test in many cases with our own money, okay, or our own balance sheet. I mean, and then be in a position to recommend to our investment committee, like, hey, this is what the AI is recommending here, and here, which we can't do in real time anymore. We can't keep up, right? We have quants who are fantastic and they understand what the output means, but they could never keep up in terms of generating the new yield opportunities at the same pace, okay? But they're excellent at managing the deployments and analyzing the risk and making sure that there's no hallucinations in the output, of course, especially by testing with our own balance sheet. That's number one, right? And we're doing that now. And that is really helping us. I mean, our USDAF stablecoin, which we launched recently, it's a yield-bearing, basically, fund, right? It is earning between 8 and it's a daily adjustment, right? It adjusts in real time based on the market conditions, but with daily liquidity, which usually has a price, it's earning between 8 and 11% right now, and at least for the last few weeks. And what I would say, with very low risk, in my opinion, okay. And so, as a fiduciary, I'm not going to recommend any product. Even if I create it with my own AI, I'm not recommending it to my clients unless I'm convinced that I'm doing right by my clients and recommending it, right? Because I'm audited by, the SEC like any other RIA, right? And so I'm very comfortable recommending that product to my clients now. And so the point being, that's partially an AI-based product already, okay? And so the second part is portfolio construction. And I think that's going to basically take over the robo-advisor space first, because those people already are using automated tools and aren't actively talking to the person. And a lot of them are already off the 60-40 portfolio because they're not just talking to an advisor once a year and, stuck on that 40%. And then the third for me kind of AI umbrella is literally, companies built from the ground up that are AI native, right? And I think you're going to see, these 1 in 5 person companies that are built to do agentic payments, right? And I just became the chairman a few months ago of Algorand, which is one of the original crypto currency platforms, the layer 1 blockchains. Sure. And we're spending a lot of time at Algorand on this new X402 payments technology, which can be used to facilitate agentic payments on the internet. What does that mean? It sounds like a lot of fancy words. The idea is that you can now use AI agents to communicate with other AI agents, but when they need to transact, they don't want to use a centralized database, right? Because where is it? Who owns it? They can't open a bank account. They're not a person. They're not a company. But they can use digital asset wallets. They can use smart contracts, crypto technology. And so you're starting to see a new crop of these AI agents emerge that is using, right, the likes of Ethereum and Solana and Algorand and Sui to facilitate these transactions, which I think is going to be the largest use case for crypto beyond the Bitcoin digital gold use case in the next 5 years.
Bill, I got so many questions. I do want to be respectful of time. I may ask if we could go 5 or 6 minutes over. I think I can narrow it down to 4 questions, or we could go a little bit rapid fire and give you a chance to wrap up. So, kudos to you here on this question. You have navigated the same regulatory storm that you hinted at over those 4 years that took out BlockFi, Celsius, Voyager, but Abra, your company, survived. What did you learn going through that process that fundamentally changed how you think about moving future forward in this industry?
Yeah. 3 things I think stand out to me. The first was risk management, right? So, everybody had losses then. Every Coinbase, Kraken, Abra, and the companies that survived were able to basically, leverage reasonable risk processes to mitigate those losses versus those losses consuming the company's balance sheet. Okay. And the companies you mentioned that didn't survive, it basically consumed their balance sheets and there was no way out. And a lot of that was very poor lending practices, centralized lending with no collateral, for example. And so risk management, if you're doing anything related to lending, whether it's DeFi or CeFi, is absolutely essential. We run a weekly risk committee, investment committee process at Abra where we look at we take the output I mentioned earlier from the AI around investing strategies and we analyze it. We talk about it and we make informed decisions ourselves. That's number one. I would say number two is understanding regulation and accepting the reality of where regulation is versus what you want it to be. You and I might be libertarians. We might want limited government. That's great. We should fight for it if that's what we believe in. And we're incentivized to do that if that's what we believe. But we also have to accept the reality of where we are in terms of operating a financial institution. And the two are not the same thing, right? So me putting on a hat that says as a libertarian, I'm going to fight for X, Y, Z, and me running a financial institution that says, here are the rules of the road today, whether I like them or not, are two completely different things. And a lot of my peers in the space have issues with that. They're not good at absorbing the difference because they're so hardcore libertarians that they just don't want to deal with the reality of U.S. law. So some of them, for example, they just forego operating in certain states, which I get it, right? And I think the third thing is understanding the adoption curve. We were very, very early. We were too early in many ways 10 years ago. And so that's fine. We're still here. But if you aren't realistic about, and this transcends crypto, this is an entrepreneurial issue in general, right? Entrepreneurs are always convinced that the world is going to see their vision 10 years before they really are. Or if ever, right? The single best advice I've ever gotten from an angel investor is, look, nobody cares. It's true. Nobody cares. Everybody is dealing with their own things, their own issues, their own life, their own business, their own families. And so, what drives people to pay attention is, incentives. And so if you're basically an AI company, people are incentivized to pay attention because they're afraid of missing the boat, right? People are incentivized to pay attention to the price of Bitcoin because they're afraid they might be missing the boat, right? They may be, incentivized to pay attention that the world order might be changing because, hey, we keep lowering interest rates and long-term rates go up. Why is that happening, right? And so, at the surface, people just don't care. Everybody's wrapped up in their own world. And as an entrepreneur, that's a very difficult thing to reconcile versus the fact that, obviously what I've just invented is the most important thing ever invented in the history of history, whatever it is, right? And I promise you it's not. And so that's probably the third and the hardest of all of the lessons for any entrepreneur.
Let's talk a little bit broadly from an investing perspective. And I'm not going to be great on being concise with my question. Let's see where I could go and you could jump in. We're led to believe, I've been in the family office community for decades. I've traveled the world. We have a long-term time horizon. Let's have an investment policy statement. Let's mitigate risk. Let's be quote unquote careful, maybe opportunistic here and there. And let's stay relatively status quo. Saying 60-40 is too simplistic, but maybe throw in a little bit of hedge funds, a little bit of private credit, a little bit of real estate. That's probably pretty generic for a lot of sub $1 or $2 billion quote unquote single family offices that are too small to get directly into certain things or be controlling owner of a sports team. I would have been on board with that to a degree even 2 or 3 years ago, but everything has changed. Moats are collapsing. I heard David Sachs on All In yesterday with a little bit of tongue in cheek because he's not always so close with Dario at Anthropic, basically state in 2 or 3 years, he's not so sure that Anthropic is not going to be the Mag One that they're so all encompassing. And now this deal with quote unquote with Elon. So you may lean a little bit more towards exponential technology. Bitcoin's going to be resistant to a lot of the quote unquote changes and may provide opportunity, tokenization. We didn't have time today to get into Ethereum and things like that. I'm going to skew to the world is changing so rapidly. You hinted at we don't have enough compute. I should be investing not just broadly equity 60%, because a lot of those are going to be stinkers and losers in a new world order where moats are collapsing. I need to be in energy. I need to be in compute power. I need to be in picks and shovels. I need to be in space. I need to think that some of the companies that I noted in 5 or 7 years, who knows, a Tesla combination with SpaceX, a before mentioned Anthropic, I'm not so sure they're not going to be $100 trillion companies. But family offices tend to be careful. How do you help them become a little bit more, that might have worked 10 years ago. How you're thinking now is not going to be good for the mindset of your rising generation and going to leave you in the dust. That's the longest winded buildup ever. I'm going to hand it off to you.
Yeah, it's a tough one because you should be thinking intergenerationally, probably. So what you've probably already done is you've put the kind of structural trusts and, irrevocable trust models in place to protect structurally the assets. And then the question becomes, of course, well, what am I investing in via that setup that I've done to protect my wealth? And I think the first thing that I did is I changed the measurement. Now, I personally look at gold and Bitcoin on a purchasing power parity basis as the basis for the success of my investments. In other words, measuring something in dollars when that underlying is losing 7% of its purchasing power a year makes no sense when you really think it through. Now, families will pay their CIO and their head of investing based upon the dollar return because they have either one of three things. I'm just going to say it. Either they're lazy, they haven't thought it through, or they don't have an alternative. Now, I've created the alternative for myself because I know that the dollar will that the Bitcoin will outpace the dollar and gold will at least keep pace with dollar inflation over the long term because of its scarcity or its relative scarcity, right? Because gold isn't scarce, there's a lot of it out there, but we only find 2% of more of it every year, whereas Bitcoin is guaranteed scarce. So if you measure your net worth in Bitcoin, you're actually you're doing better than dollar debasement, okay? So if you change the measurement and think it through, you don't have to use Bitcoin. You don't have to be a maxi, but stop thinking in terms of, you should basically take 7% off the top before you measure the effectiveness of any investment strategy. Meaning you're going to give me a return. I'm going to basically multiply that return times 0.93 to see how well you're doing. Okay. And because, you're losing 7% on a purchasing power parity basis every year anyway. And so when you start to process
do you think that's mainly due to the money printer?
It has to be. You can't increase the money supply, right? And basically, look, what is money at the end of the day? All it is a way to value and store productivity. Okay. It should have been to store productivity. We also value productivity in it because we change the amount of money in circulation, which then lowers the value of your past productivity, which was never the part of the grand bargain. Never. We simply accepted it and moved on because it's the proverbial frog being put in cold water and slowly turning up the heat. Okay. That's what we've done to people. That's what we've done to the middle class. We told them we will never devalue your productivity. That was Bretton Woods. Okay. In 71, we basically put them in the cold water and started to turn up the heat a little bit. And now it's at a boil, but you can't get out of the water because you're like, I'm dying. Right. And so, but if you're a wealthy family office and you're not thinking this way, you're simply running in place like, Fred Flintstone trying to start the car. And so to me, the way to think about it is start from a different place. Assume that the dollar loses 7% of its value a year And that's what you need to simply maintain what you had before. So if you're putting money in treasuries, you're losing 2 to 3% of your net worth on a purchasing power parity basis a year, at least, right? What are you going to do about it? And so when you start to think about it, I'm not trying to give you a non-answer or cop out. I genuinely think this way, right? And so now I have a different framework for measuring financial success going forward. Not how I got here. That's done already. Now what am I doing going forward? Right? Every investment I look at has to be more liquid than, unless it's some passion project. It has to be just as liquid as Bitcoin and have a high chance of beating Bitcoin over a sustained period of time, right? And especially if it's a venture investment, which is illiquid, there has to be a price for that, which means it has to do much better than Bitcoin because my funds are going to be locked up for 5 to 10 years, right? And so that's basically the layer on top of that 7% debasement that helps guide me towards, different investments and say, okay, well, stocks are going to keep pace, right? That's, if I just buy the S&P 500, I'm literally spinning my wheels and my net worth on a purchasing power parity basis will basically be the same 10 years from now on average.
My final question, and it kind of builds up a little bit on the last one. And there's really, really smart people in finance, on Wall Street, and of course, in family offices. So this one, I'm not picking on the family offices, more to Wall Street. They kind of whiffed for the most part on Elon and Tesla, looking back 10 years ago. They definitely broadly whiffed or a little too late on the exponential returns in Bitcoin. And they were slow to the game even 5 years ago to NVIDIA. So the question that I want you to kind of finish for me, the thing the smartest people in finance still fundamentally misunderstand, Bill, is what?
Exponentials. I mean, that's what I keep coming back to, right? Whether it's compounding on the one hand, or how networks change on the other, how the internet changed us. It just crept up on everyone, but to anybody on the inside who was watching the network grow, it was obvious. People who aren't adopting AI right now, who don't understand the exponential growth, who can't comprehend why 3% of 4% of GDP is now related to compute, needs in this country, compute demand. But it's next level. Right. It's exponential technology at the end of the day.
Of course. And you've been very kind with your time, Bill. And I will do a little bit of a close at the end, but I'd like for you, and again, everyone today, our guest was Bill Barhydt, spelled Barhydt. And again, founder and CEO at Abra. Bill, for those that would like to learn more about you or follow you on socials or reach out to Abra with all the services that they provide, how could they do so and learn more?
Sure. So I'm very active on Twitter and X. Just follow me there, Bill Barr, BILLBAR. You can go to abra.com to find more about our services. We specialize in yield and lending, in particular in the digital asset space. So if you're holding Bitcoin, want to borrow, you're earning, you want to earn yield on your crypto positions. We have a very safe kind of vault-based model for doing that. We manage separately managed accounts for our clients. And so we would encourage family offices to take a look at that. We think we really architected it for all of you at the end of the day as our primary clients. So, come find us and be happy to talk more.
You're very kind, Bill. And because we do have some new folks, probably from your amazing audience, I'll try to keep it a minute, but do a little bit of a close. First of all, it's great to do an interview again. I haven't felt like I've done one in like a month and a half. Hopefully, Bill, I didn't lose a little bit of my touch after doing hundreds of 2-hour plus interviews, but I've done a lot of solos lately and a lot of travel around the world. Again, everyone, I'm the original founder, multi-decade CEO at Family Office Association. a consortium of single family offices. I sold that several years ago, kind of retired, have a holding company and family office out of Wyoming, kept all my social medias active, started to blow up a little bit with the younger audience. Now that I have no board, no investors, I could talk about whatever I want to talk about. So some of my views may be a little bit extreme for some, and I'm sure I'm wrong my fair share, but the ability to have open and honest discussion and debate, which like never happens in the family office world because it's so careful and guarded. And again, I'm imperfect, I make mistakes, but my love is traveling the world, meeting incredible entrepreneurs and families, and my experiences creating dynastic global family offices. And a lot of the core topics besides the creation of a family office is bigger picture items like geopolitics, where we put it all on the table, macroeconomics, which came up today, part of our discussion with Bill, and AI might be the savior to that relative to deflationary impact and the impact on GDP. We could only hope. I'm putting out a little bit of hope out there, but there could be, to our massive debt and deficits as well that we have in this country. And of course, investing. Who doesn't love investing? And I'm putting my money where my mouth is. I'm extremely active, mainly more so public markets and picks and shovels and AI and energy and a lot of the unique plays around that. It's been such an incredible time. And many of the newer audience kind of knows me as the AI guy meets the family office. I'm helping families create dynastic AI native family offices. I'm living through it. I do frontier models, open weight models. I do open claw Hermes. I am all in and very, very deep. We didn't have the time to get in with Bill today about what companies are going to look like in the future, doing more with less, better, and faster. We hinted a little bit at AI agents. That is obviously going to be huge. And there is going to be a societal impact as well. All things for future discussions. You could follow me on social medias. I'm often at Family Office on YouTube and X, Angelo Robles on LinkedIn, and go to angelorobles.com to learn more about single family offices, what I do, and my AI masterclass in New York this June 23rd and 24th. Thank you all so much. Thank you, Bill, for being a great guest. I look forward to seeing you, and thank you so much. Look forward to next time. Thank you. My pleasure.